Hello, my awesome accounting students. Welcome back. Chapter 12 brings us farther along in the accounting cycle for merchandisers. You have your work cut out for you. This chapter covers accruals, deferrals, and that 10-column worksheet. Before moving on, let's take a look back at where we've been. We've discussed the full accounting cycle for a service-oriented business. We then went on to some special topics about payroll and cash. And of course, we've partially worked our way through a merchandiser's accounting cycle. Chapters 12 and 13 will finish the cycle up. Looking forward, this chapter is about the adjustment process. Yes, we've talked about it once before, way back in chapter 5, but in this chapter, the author is going to hurl probably 10 plus new adjustments towards us. So let's get started. In chapter 5, we learned how to make adjustments so that all revenues and expenses that apply to a fiscal period appeared on the income statement for that period. In this chapter, we're going to learn more about adjustments. Remember, we are using something called the accrual basis of accounting. We learned these very early GAAP rules when we first started the class. We said revenue is recognized when earned, not necessarily when the cash is received. On the slide, you will see that revenue is recognized when the sale is complete. We learned in a previous chapter that the sale is complete when title to the goods passes to the customer or when the service is provided. For sales on account, the revenue is recognized when the sale occurs, even though we may not get the cash until another period. This is a fundamental rule of GAAP accounting. Likewise, expenses are recognized when incurred, not necessarily when the cash is paid. Each expense is assigned to the accounting period in which it helped to generate the revenue for the business, even if cash is paid at some other time. These two together are referred to as the matching principle. In this course, we are using what's known as a periodic inventory system. That means that inventory is only adjusted one time at the end of the fiscal year when a physical inventory count is made. The adjustment for merchandise inventory means that a business has to account for the goods on hand for sale to customers. Although we learned about an asset account that holds the merchandise inventory, we also learned that we have not yet touched that account. When we purchased merchandise, the account purchases was charged, and when we sold merchandise, the revenue account called sales was used. Therefore, inventory has not been adjusted, and so what's sitting in the inventory account is the inventory from last year. So we're going to learn this adjustment in 2 steps. I'm going to call it take out the old and then put in the new. In the last slide, we saw that the inventory account from last year held a balance of $52,000. Our first step will be to take this $52,000 out. In order to do this, we need a temporary holding account. Back will come income summary, that junk drawer account that we talked about previously that was used for closing and then it went away. So to take out the old inventory of $52,000, we will credit merchandise inventory and transfer the amount temporarily into income summary. Now you will see that merchandise inventory is zeroed out. Now that we have a zero balance, let's put the new inventory of $47,000 back in. How do we do this? We debit the merchandise inventory account and credit the income summary. These two balances will both be transferred to the worksheet. This will be the only account on the worksheet that has both a debit and a credit balance. So pay particular attention to this adjustment. To recap, this is the journal entry to remove the old inventory, and this is the journal entry to put the new inventory back in. Our next journal entry deals with uncollectible accounts. Credit sales are made with the expectation that the customer will pay the amount due, but sometimes the accounts receivable is never collected. Losses from uncollectible accounts are normal and are classified as operating expenses. Under the accrual basis of accounting, the expense for uncollectible accounts is recorded in the same period as the related sale. The expense is estimated because the actual amount of the uncollectible accounts is not known until later when the customer defaults. To match the expense for uncollectible accounts with the sales revenue for the same period, the estimated expense is charged to an account called uncollectible accounts expense. There are several methods available for estimating the expense. In this case, we will use the easiest one, called the percentage of net credit sales method. The rate used is based on the company's past experience, along with management's assessment of current business conditions. In this case, the company estimates that 4/5 of 1%, or 0.80% of net credit sales will be uncollectible. Since the net credit sales for the year were $100,000, the estimated expense for uncollectible accounts is $800, or $100,000 times 0.8%, or 0.0080 on your calculator. The entry to record the expense also includes a credit to a brand new contra asset account called allowance for doubtful account. Take a moment to review the journal entry because, again, it's a new one. The debit is to uncollectible accounts expense, and the credit is to allowance for doubtful accounts. Again, this is a contra asset. When the adjustment is made, the expense is placed on the income statement, and accounts receivable is brought down to its net realizable value. Let's take a look at how the balance in the allowance account, now $1,050, would be shown on the balance sheet. That previous adjustment increased the allowance for doubtful accounts up to $1,050. This brings the accounts receivable balance from $32,000 down to its net realizable value, otherwise known as net receivables, of $30,950. Before we go any further, let's not forget that we have learned about 3 types of adjusting journal entries in a previous chapter. All 3 of these were deferred expenses. The first one you see was the adjustment to record supplies used up. Sometimes we had to compute the adjustment, and sometimes the amount was given to us. Secondly, you'll see the example of a prepaid account being adjusted. In this case, it was prepaid insurance, but it works the same for other types of prepaids as well. And in the third one, we learned one method called straight line depreciation that we use to allocate the cost of an asset over its life. Take a look at these 3 journal entries. I'm not spending any more time on them, but they are definitely an integral part of this chapter. Let's now take a look at 3 different types of accrued expenses. Many expense items are paid for, recorded, and used in the same accounting period. However, some expense items are paid for and recorded in one period, but used or they benefit a later period. Accrued expenses are expenses that relate to the current period but have not yet been paid for and do not yet appear in the accounting records. 3 common types of accrued expenses that we will look at in this chapter are accrued salaries, the accrued payroll taxes that relate to the salaries, and the accrued interest on notes payable or any other debt that we may have. Let's assume that a company has a pay date on Friday, and let's also assume that the average 5-day payroll is $2,000. This equates to $400 a day. If the fiscal year ends on a Wednesday, that means that 3 days would have been worked in one year and 2 days in another. Rather than wait until the Friday to record the money that's due, the company must accrue the salaries expense for the 3 days that fell in 2019. Here is the adjustment to accrue the salaries. Salaries expense would be debited for $1,200 and salaries payable would be credited for the same amount. For the same reasons, we must also accrue the payroll taxes. Although payroll taxes are not legally owed until the salaries are paid, businesses that want to match revenues and expenses in the appropriate period make adjustments to accrue the employer's payroll taxes. The payroll taxes related to the employees are recorded much in the same way as they were when we learned about them. For the adjustment, we would debit payroll tax expense for the sum of the 4 payroll taxes. Individually, we would credit Social Security tax payable, Medicare tax payable, FUTA tax payable, and SUTA tax payable. These would be computed the same way they were computed in the chapter. This is Professor Johnson signing out.